On this morning's Ag Issues program, it is a pleasure, as always, to bring on to the program the ever-busy Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you.
Well, as always, appreciate you being on to the program this morning. And let's first talk about, and this is the as you have deemed it, how not to use a charitable remainder trust. And that charitable remainder trust, it can be a useful estate planning tool for farmers and ranchers out there, and I guess particularly ones that are ready to retire from farming and ranching. But you have a case out of Indiana that is, I don't know if you would say the prime example or the here's not what to do if you make presentations like this, but boy, oh boy, this got to be a very, very complicated case.
Well, it was a disaster is what it was, and I'm still trying to scope out the background on this. There's got to be a background story as to how this happened. All I know from reading the tax court's opinion is that it starts out by saying that the farmers here, a married couple, read an ad in a farm magazine. And then once I read that, I thought, oh, no, this is going to go downhill pretty fast. And it sure did. About everything you could possibly do wrong with a charitable remainder trust, they did. And I don't know who was advising them, how they got into this. I'm still trying to source out the ad that ran in the farm magazine probably 10 years ago, because the years at issue were 2015 and 2016. They would have had to have seen the ad before that to get this lined up and done. So it goes back, but the case is brand new. It's out of the U.S. tax court. Just came out a couple of months ago. But you're right. A charitable remainder trust is a really good tax planning technique, even as part of an estate plan. Because if you're getting ready to retire, and I put the word retire in quotes when we use it with respect to farmers and ranchers, but if you're stepping away from crop production, for example, and you're transitioning to somebody else, probably what you've done from an income tax planning standpoint as a farmer is you have deferred last year's crop income into this year, and now you have your last crop this year. You won't be able to defer it next year because you won't be farming, and so you've got two streams of income, 2 years' worth of crop sales that potentially are going to pile up in your last year. So instead of selling that last crop and reporting the income along with the income from the previous year's crop, that you've deferred, what you do is you transfer it to a charitable remainder trust. Now, what that avoids, what I would normally tell people is be careful if you're going to put crops into a charitable remainder trust. Just understand what's going to happen to you when you do that. Now, what you're going to do is you're going to avoid the income from the sale of the crop because the transfer to the trust is not a sale, and you're going to avoid self-employment tax on that sale by transferring it to the trust. But this is where things get really complicated. And that's not normally, if you want the full-blown effect, positive effect of a charitable remainder trust, we don't put crops into a trust. But if you understand that you're transferring property that has zero income tax basis into a trust, you won't get a charitable deduction because you can't get a charitable deduction for more than what your basis is. You're going to be limited to zero. Unfortunately, in this situation, these people put their crops into a charitable remainder annuity trust. They put soybeans in 1 year. They created a second trust. They put their corn crop in the next year. Then they claimed a charitable deduction. Well, you can't do that because you don't have an income tax basis in the crop. So you're not going to get a charitable deduction. So then they claimed, well, we sold the crop to the trust, which established a purchase price basis in the hands of the trustee, which was their son. That's a no. You didn't sell it. You transferred it to the trust. And by the way, if you're claiming that you sold it to the trust, then you're going to have to report the sale income on Schedule F, which they didn't do. So another problem. So IRS gets all interested in this. They audit this, and they blow this thing to smithereens. They don't get a charitable deduction. They don't have a basis in the crop. The trust was misreporting income items, misreporting claimed loss deductions, and they lose everything from a tax standpoint, and they get a substantial understatement penalty imposed against them. This is Disaster 101, and it just points out that when you create a charitable remainder trust, you need to have it set up by somebody who knows what they're doing. The rules are really, really technical, or you can get into a real mess like this case.
And I go back to the very beginning of this, and well, you don't want to be critical, but in this case you have to be. Getting an ad from a magazine, be it a farm magazine or whatever the case may be, there's only one way, like you said, there's only one way this is going to go.
Yeah, and you were there a month ago. I mentioned this case in my presentation at National Association of Farm Broadcasters, and my point on that was, and my comment was, make sure, and this is to farmers, make sure when you see something like this, take it to your tax counsel, run it by somebody else, get a second opinion on it. We get second opinions on health issues all the time. Do it on legal and tax issues. If you see an ad for some type of medical device or procedure or some type of product on TV or in a magazine, we're going to go take that to our doctor and ask our doctor if that's okay. Well, take this to your lawyer or your CPA or your tax professional. Just have them check it out. And if they don't have expertise in this area, because this is incredibly complex, they'll find someone for you that does. But just don't take it at full value here and go headlong into it. The thing that really strikes me on this one, Greg, is these are Indiana farmers, and they were represented in the tax court by an attorney out of San Jose, California. I'm still trying to figure out how that happened, which leads me to believe that this was probably some sort of package deal where the company that was promoting the trust had legal counsel, in tow on this in case something went wrong. That's not a good scenario for farmers to get into. You want to be dealing with somebody that at least is in your part of the country, somebody that you can talk to face and go over these things in detail. And I just fear that that didn't happen in this instance. We got a really bad result for a farm couple that shouldn't have happened.
Because this goes back to, and I guess I would assume it's for any type of case, let alone this one with the complexity of the rules, that still, if you have any questions whatsoever, that's why you hire tax preparers to be able to help you in whatever the situation is.
Right, and keep in mind the numbers in this case were pretty large, and yes, it does cost to get competent tax advice, but when you're dealing with a grain sale of $691,827 in 1 year and about half that amount in another year, you're looking at close to $1 million worth of grain that's being transferred into a trust. You're playing with big numbers, and so it's important to really get good tax advice. And yeah, you pay a little bit, but to save a lot. That's the idea. You don't want to scrimp on paying and buy a package deal like this and then have the whole thing go south on you. You just this was a terrible result for this family.
And especially what gifts of property other than, I think it's the publicly traded securities, and especially if they are in excess of $5,000, there are things that the taxpayer must do as part of this too.
That's right, yeah, and we usually don't deal too much with that in transfers of when farmers do this with respect to trust. But the point is, if you're transferring ordinary income property, this is the big issue for farmers, such as a grain crop. There are ordering rules when the income comes out of the trust, because what the trust is going to do is the trust will sell the property that's been transferred to it. That's non-taxable because the trust is a charitable organization, and it will fund the annuity back to the farmer, that income stream, over the term of the annuity or for life, however it's set up. But the income ordering rules under the code is that ordinary income is reported first. So if you're transferring ordinary income property, such as crops, into a trust, then it's all ordinary income when it comes out. So that's another thing. If we're trying to set it up so that we benefit a charity with the remainder in the trust after the annuity's been paid, then we don't want to put ordinary income property into the trust. We want to use other types of property, such as machinery and equipment and other items, but not ordinary income property. So, but again, you can set up a trust, and as long as you can put crops into it, and you can avoid the self-employment tax, avoid the income on the sale of the crop because it's not a sale. But as long as you know you're not going to get a charitable deduction, and you can understand that you're going to have to pay ordinary income tax rates on the annuity stream that comes back to you, I'm okay with that. That's fine. These folks didn't get that advice, and they were shocked by that, and then they have IRS coming in and saying, well, you underpaid. You're taxed by $55,000 in one year, $56,000 in another year, $95,000 in another year, and, oh, by the way, we're going to hit you with an additional 20% underpayment penalty on top of all that. So they end up with, well, what is that? That's about $200,000 in underpayment plus a 20% penalty. So the IRS is saying, yeah, you owe us $250,000.
Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, is joining us. And Roger, you have a couple of other recent court opinions showing the uniqueness of unique tax laws and how unique they can be. One concerns does using old tractors mean you aren't a farmer? And concerning the wind energy production tax credit, and is it subject to a state property tax?
Yeah, well, I think the first one shows us how unique an issue that the IRS might raise. I'll come back to that in a moment and make another comment on this. But this was an Iowa farmer. This is a tax court decision that just came out last week. And it was an opinion by Judge Paris on the U.S. Tax Court, who, by the way, is the only judge on the U.S. Tax Court that has an ag background, and she's going to retire next summer, which scares me to death. We're not going to have any unique expertise on the U.S. Tax Court after she's gone. But she got this case, and what this is an individual that graduated high school in 71, bought his first farm in southwestern Iowa in 75, got married in 77. He and his wife moved into the 100-year-old farmhouse that's on the home place. And he's got an idea as to how he's going to farm. He's not going to buy new equipment. He's always going to use used tractors and combines and machinery and implement. In fact, his first tractors were manufactured in the 40s and the 50s, and that's what he did all the way through. And by the time we got to the audit, the IRS revenue agent came in and audited, and he had 5 tracts at that point in time and accumulated about 500 acres. These tracts are all non-contiguous, and that's an important point here, as we'll see in a moment. And they were anywhere from 6 to about 14 miles apart. And so he's acquiring farm machinery and equipment over the years. He also works full-time, and before he would start his shift, he would farm in the mornings early. He would go do his job, and as the tax court judge said, as Judge Paris said, that he would work from about 6 o'clock to midnight every night. He did this year after year after year, over 40 years of doing this. Never build up debt. He would always pay cash for his equipment. He might finance land for a little bit, but he'd get that paid off. He made it through the 80s. He struggled through that. He made it. He didn't get in head over heels in debt. And this was his practice. And he's built a successful cow-calf operation and a row crop operation. Well, IRS comes in and audits and says, well, you've got way too many tractors. You've got 40 tractors. And he said, well, yeah, I park them on my different tracks, and I use them for different reasons. And Judge Paris goes through this and says that, yes, he's using this tractor for this and that one for that. That's why this is at that farm. It's hooked to those implements. He had a hard issue about 10 years ago, and he's explaining, well, it saves me time and effort in attaching and detaching and assembling and disassembling tractors, and I can take parts off this tractor and put it on another one. You know how that works in agriculture. And so Judge Paris goes through all of this and says, no, he's a farmer. That's what he does. He doesn't have to drive these tractors from track to track. He has them sitting there ready to go. They all have their unique uses. He does his own repair and maintenance work. He doesn't have to hire anybody to do that. He owns the technology on the tractors. He doesn't have to deal with that issue because they don't have technology on them. And this is the way he operates. He is a farmer. Well, the IRS tried to say that, well, obviously he's not because he's an antique collector. And Judge Paris just didn't have anything to do with that argument. That's just silly. But it shows you the point at which some of these IRS revenue agents can go. And I said I was going to come back to that issue. And what scares me, Greg, about the effort to put $80 billion into hiring new IRS agents, well, yeah, they do need that. Yes, they're going to lose about 50,000 in the coming years due to retirement and just attrition. But there's a learning curve when you hire revenue agents, and you have to have the well-trained people train them and get them up to speed on issues, and new agents like to be aggressive. So while I would have liked to have seen the bulk of the funding of that $80 billion go to service and upgrading computer systems rather than enforcement, my fear is that when they do that on the enforcement side of things, you get people trying to enforce rules that they don't fully understand. This case should have never gotten to the tax court. This is not one that should have gone up the chain this far. Somebody in IRS should have smacked this down and said, no, you can go through the depreciation schedules and check things. And there were some errors on the depreciation schedules, but these major points the revenue agent was making was just ridiculous in this case.
And then you've got the second case that you had mentioned concerning the wind energy production tax credit and whether or not it's subject to a state property tax.
Yeah, that's been a big issue in numerous states, and the question is unique to specific state law and a specific state constitution. And in Oklahoma, the federal production tax credit is not subject to state-level property tax. That's not the situation in other states. It has been held to be subject to state property tax in Illinois, Michigan, Pennsylvania, South Dakota, and Tennessee. But Oklahoma reached the opposite result based on their unique law, and that's been the same result in Arizona, Georgia, Missouri, Ohio, Oregon, and Washington. But the point here, I thought there was a really interesting stat that came out in this Supreme Court opinion in Oklahoma, was that the county assessors in Oklahoma valued this wind energy project at $458 million when you included the federal wind production tax credit. Without that, it's only worth $169 million. You do the math and then tell me, would we have any of these projects if it weren't for the production tax credit? And I would argue you would not, because that's where the value is in these projects. They're farming the tax code, and this case really points that out.
All right. Well, Roger, we are out of time, but as always, very much appreciated. Obviously, we won't talk to you till the day after Christmas, so to you and your family, a very Merry Christmas.
Thank you, Greg. Same to you.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.